History has shown us that price spikes due to geopolitical events are temporary, and investors should look to fade the initial reaction. Another month and another market development to deal with. As equity investors, it feels like we are rolling from one crisis to the next. In 2 months, we've had to navigate an RBA rate hike, a bear market in software stocks, rising concerns over private credit and its linkages, disruption in numerous old economy sectors as a result of AI, a continuation of growth stock weakness, and now a conflict in the Mideast, which has driven a spike in energy prices and a sell-off in equity markets. That is also not to forget the February reporting round, which was accompanied by a level of price volatility not seen before. The good news is that up until a few days ago, the Australian equity market was bouncing around all-time highs, similar to other major global indices, with the exception of the Nasdaq, which had been dragged lower by the software sell-off. It's possible to think that the market has been complacent given the long list of headwinds, but that's not how we see it. Instead, peak equity markets reflect underlying strength and a change in equity market leadership that has been sufficient to push markets higher, while areas of weakness have either emerged or persisted. For instance, Australian tech is down 22% year to date, while energy, materials and consumer staples are up 22%, 18% and 10% respectively. This dispersion is unusual and extraordinary, but as we highlighted in last month's CIO update, investors are not dumping equities as concerns emerge. Rather, they are isolating the impacts and then rotating into other areas that have greater valuation protection, yield support or earnings upside. This leads us to the current crisis, a Middle East conflict between Israel, the US and Iran that is only 4 days old, but which threatens to drag in other Gulf nations as well as allies of the US. The main transmission mechanism of the conflict to the global economy and macro markets is via its impact on energy prices, with the severity and duration of the disruption to oil and gas infrastructure and shipping lanes the key determinant. At this stage, we're seeing a relatively modest spike in oil prices, with the WTI up around 12% versus pre-strike levels to $72 a barrel. This pales in comparison to the spike seen during the breakout of the Ukraine-Russian conflict, which saw WTI prices momentarily reach $128 a barrel. Several reasons have been put forward for the muted response, not least expectations for the conflict to remain short, but global oil market dynamics have changed. First, the US is now the world's largest producer with over 400 million barrels of strategic reserves. Secondly, global stockpiles, while modest compared with history, stand at around 2 billion barrels. Third, oil at sea, sitting in tankers, is significant. And lastly, rerouting of Mideast exports in order to bypass the strait can also be significant. Finally, the oil industry is now used to dealing with supply-driven disruptions, and that drives a wait-and-see response from markets rather than pricing in a worst-case scenario. Cross-asset impacts from an oil price shock come via 3 channels. First, it's a drag on economic growth. Second, it redistributes income from oil-consuming economies to oil-producing economies. And third, it's inflationary. At this stage, it's too early to tell what the impact will be, but we think markets are calibrating the risks appropriately, with a modest spike in oil prices and a modest decline in risk assets. Historically, geopolitical events have not led to sustained declines for equity markets. In fact, over the last 60 years, the US equity market has been higher on a 1, 6 and 12-month basis post the start of a geopolitical crisis. The key determinant is how far oil prices spike and how long they remain at elevated levels. For now, we think equity markets can absorb a $15 to $20 increase in the price of oil without too much fanfare, given this is unlikely to pose a major threat to the global economy or alter central banks' policy decisions. In Australia, we've just emerged from one of the strongest corporate reporting seasons in many years. Earnings growth has broadened out. Corporates have harvested the gains from price increases and strong cost control, and the market is not under the same threat from over-investment in tech as other economies are. In addition, the consumer is holding up, and the labour market remains tight. These are strong underlying supports for equities, even if concerns around the Mideast persist. Finally, history has shown us that price spikes due to geopolitical events are temporary, and investors should look to fade the initial reaction given a shoot first, ask questions later type response. While we're not discounting the potential for higher oil prices to have more significant impacts on equities, at this stage we are comfortable assuming that drags will be modest and remain localised. Ultimately, we think the narrative paints a more concerning outlook than the actual implications, perhaps tied into a dislike for US President Trump. And while investors should be cautious given the conflict remains in its early stages, we don't think they should be chasing energy exposure or de-risking equity positions. Before the Middle East conflict began, the Reserve Bank of Australia was already facing an uncomfortable inflation problem. Underlying inflation had moved well outside the 2 to 3% band, driven less by goods and more by sticky services, housing costs, and resilient domestic demand. The RBA's own February forecast conceded inflation had surprised on the upside and would take longer than expected to return to target, prompting a reversal in its policy direction that started with a February rate hike. That backdrop matters because the escalation in the Middle East now risks layering a classic supply shock onto an economy that was already running warmer than policymakers would like. The spike in oil prices following disruptions to shipping through the Strait has raised the near-term risk of higher fuel and transport costs, feeding into headline inflation and, more importantly for the RBA, inflation expectations. Governor Michelle Bullock has been careful not to prejudge the outcome, noting the conflict could ultimately prove disinflationary if it meaningfully dents global growth. But the immediate concern is asymmetric. The bank can afford to look through a short-lived petrol price spike, yet a prolonged energy shock would complicate the risk of re-anchoring inflation in an economy where capacity pressures have not fully eased. The net effect is that the RBA's reaction function has become more hawkish by default. Markets should be treating every meeting as genuinely live, with the bar for renewed easing high and the risk skewed towards more tightening than previously signalled if inflation proves persistent. We think delaying rate hikes carries diminishing returns, and the RBA should move in March. With inflation already uncomfortably high, waiting for perfect clarity does not provide the RBA with much additional information, but it does risk requiring a larger adjustment later. In that sense, moving earlier, even modestly, may prove less costly than waiting, particularly if energy-driven price rises spill into wages, rents, and services. The RBA has an inflation problem, and the Mideast turmoil should not be used as a foil in timing its policy rate moves.